Welcome to Cat Eye US Stock. We watch markets with calm focus and sharp instincts. It's Monday, March 9th, 2026, and today was whiplash. The open felt like blind panic, classic energy crisis tape. Then the whole market flipped hard into an aggressive tech-led squeeze. By the close, the S&P 500 was up about 0.8%, the Dow added about 0.5%, and the Nasdaq led with roughly a 1.4% gain. But don't let the green indexes fool you. This was a generals-led save, with real damage still showing under the surface. Now, look at the S&P 500 heat map. It reads mixed to green, but that green is not evenly spread. Your eye goes straight to semiconductors, names like AMD, Micron, Broadcom, Intel, and NVIDIA, and to communication services leadership like Alphabet. Outside of that, a lot of the board is muted, kind of gray. And Telecom, AT&T, Verizon, T-Mobile sticks out as a red island. So yes, the index finished up, but participation looks selective. And that heat map lines up almost perfectly with the money flow. Capital rotated into the highest conviction lane, AI compute, and the semiconductor supply chain, while still keeping a defensive barbell in staples and utilities. Meanwhile, Telecom is where the air came out, and financials lagged in a mixed-to-weak way, even as the indexes pushed higher. Put it together, and the message is pretty clear. Risk appetite showed up, but it wasn't broad. It was concentrated, and it was very positional. Here's the tension that really defined the day. The session started with the market pricing in a serious energy shock. Then, per the override narrative, it pivoted hard after a White House comment that the war was, quote, pretty much complete. The move that followed felt violent and algorithmic, much more squeeze than serenity. And even with the green close, the under-the-hood picture stayed uneven. Narrow leadership, telecom bleeding, and a separate warning flag going up around credit market liquidity. So the tape didn't resolve fear, it just rerouted it into the AI generals. On the chatter side, traders pointed to a single White House sentence as the spark for the reversal. Some desks framed the afternoon as an algorithmic short-covering squeeze. That's how people talked about it in real time, even if the exact mechanics are hard to prove from price action alone. The other storyline was a geopolitical worst is over off-ramp, even as Strait of Hormuz risk was still being discussed. And in the background, there was plenty of desk talk about tight liquidity in parts of private credit, more of a stress signal than a front-page equity headline. This week, the market's attention started to shift from the war in Iran to a brewing storm in so-called shadow banking. For years, private credit was sold as a golden age of lending. But as of March 8, 2026, that shine is fading fast. We've seen a rapid-fire series of gates coming down at some of the world's biggest asset managers, Blue Owl, Blackstone, and now BlackRock. The core issue? A roughly $162 billion maturity wall hitting just as AI begins to cannibalize the revenue of the software companies that took these loans. And this isn't just a Wall Street problem, it's a Main Street problem. These funds were marketed to retail investors as semi-liquid bond alternatives. Now, millions are finding their cash locked behind a 5% redemption cap. In the next two slides, we'll break down who's failing to pay and why the funds can't just hand you your money back. To really understand this credit freeze, you've got to look at who's actually borrowing the money. Over the last 5 years, private equity sponsors stuffed their portfolios with SaaS companies, treating recurring revenue like a guaranteed bond. But by March 2026, the so-called SaaSpocalypse has arrived. These companies were underwritten at roughly 8 times revenue, and now AI agents are starting to automate the very tasks that software was built to do. That revenue is evaporating, and because these are asset-light businesses, there's no factory to sell when things go wrong. Right now, nearly 9% of these borrowers are using payment in-kind interest, basically putting the interest on a credit card just to stay afloat. So we're not just seeing a credit crunch. We're seeing the business model of 2021 tech lending go obsolete in real time. If the borrowers are the fire, the fund structures are the fuel. Traditionally, private credit was for big institutions that could wait a decade for their money. But by 2026, the market had been democratized, pushed into retail wealth channels through BDCs, and that's where the liquidity mismatch shows up. Funds like BlackRock's HLEND and Blackstone's BCRED own long-term illiquid loans to startups, but they told everyday investors they could pull cash every quarter. This week, the gate came down. With redemption requests pushing up toward 10% in some funds, managers are locking the doors to avoid a 2008-style run. This isn't a solvency crisis where banks collapse. It's a liquidity trap, where your so-called safe 8% yield is now locked up by a manager who can't find a buyer for a failing software loan. NVIDIA was one of the key generals today, up about 2.7%. In the raw tape read, NVIDIA staying green helped flip the market's emotional tone from cautious to constructive. The move was framed around ongoing AI platform focus and pre-GTC anticipation. Bottom line, when NVIDIA is bid, it can paper over messy breath, and that's exactly what today's indexes looked like. AMD jumped about 5.3%, a clean tell that traders were re-risking specifically into semis. The read was simple: broad chip buying on an AI and compute momentum day, more about that one lane than the whole market. After a move like this, the next tell is straightforward. Does the bid stick, or does it turn into fast profit-taking? Micron was up about 5.1%. The stated catalyst, analyst optimism, plus a memory pricing and cycle story. Micron matters because it often signals risk on within semis. It's how the market leans into the broader AI supply chain, not just the headline GPU names. Alphabet climbed about 2.7%. The tape read it as a megacap bid in communication services, with AI narrative spillover and some reallocation into liquid leaders. And it mattered for a simple reason: when Alphabet joins NVIDIA on the upside, it turns a single-lane rally into something that can actually hold an index together. AT&T dropped almost 3.9%, and it became the clearest symbol of what did not work today. Telecom showed up as a standout red pocket on the heat map, and AT&T's weakness confirmed it wasn't just a quiet rotation. There was real selling pressure in that corner. On a day when semis ripped, Telecom bleeding is your reminder this rally wasn't uniformly healthy. Cisco fell just over 3%. The backdrop was lingering margin and forward guidance concerns, with investors de-risking networking even as AI demand talk stayed loud. It's a useful micro-divergence. Today's market rewarded compute and the chip supply chain, while discounting parts of the networking story. Looking ahead, there are no major high-impact U.S. macro releases flagged for Tuesday, March 10, 2026, so the tape can stay very headline-driven. The bigger calendar hits next week: Empire State Manufacturing on Monday, pending home sales on Tuesday at 10 a.m. Eastern, then Producer Price Index and Core PPI, plus the FOMC rate decision, statement projections, and press conference on Wednesday afternoon. Thursday brings jobless claims, Philly Fed, and new home sales. Into that backdrop, watch whether the AI generals keep getting defended, because today's breadth was narrow, and that makes this tape more sensitive if leadership stumbles. So that's the day, a panic-to-relief reversal on headlines, with semis and megacap AI doing the heavy lifting into the close. But the heat map also told you what to respect: telecom weakness, mixed financials, and a rally that never really broadened out. Next session, the key tell is simple: does money keep paying up for the AI lane, or does this snapback fade the moment the headlines change? Thank you for watching Cat Eye US Stock. Stay curious, stay calm, and we'll see you next time.